Good afternoon, good morning, good evening, wherever you are.
Wherever you are. Oh, holy moly. It's almost noon. I just wanted to get one more last take look at the market, but, it'll be different by the end of the day, but it's not looking great today. Anyway, we are almost at the end of the month. Next
Amazing.
week will be the monthly candles. Could do yearly candles next week. It's just pretty crazy. Anyway, it's been a pretty interesting week, and it's slow, low volume. Same thing will be next week because New Year's is Wednesday also. So
yeah, these 2 weeks are usually kind of boring,
yeah.
But they're kind of not.
The
Stuff's going on.
The hard thing is it can go either way. Like, there's so few people around that are actually working in Wall Street that volume is really low, so there's not too many shares being traded, and it can really drive price in one direction or the other. It can be very erratic, and so it is what it is. We're getting some pretty big volatility this week. Anywho, want to take a look at what happened this week, and then this is going to be basically a bullish podcast. I'm gonna try to be as bullish as possible. I get 3 kind of big picture reasons why we should be bullish going into 2025, even though the first one seems to be getting blown up today. And then we'll look at the TSP fund charts. So Monday, durable goods orders fell to minus 1.1 in November versus an 0.8 gain in October, which is the bad news. Good news, building permits were up 5.2% in November versus down 0.4 in October. So some, like always, some positives, some negatives in the market. S&P was up 0.73% on Monday. And then Tuesday, Redbook year over year was up 5.9% on the week of December 21st versus the same week in 2023. The trend has basically been flat since the third quarter of 23. So same-store sales haven't rolled over yet. S&P was up 1.1%. That's what this looks like. So Redbook numbers are year-over-year retail. It's retail stores year-over-year sales. So basically, from the bottom in COVID to the top in 21, year-over-year retail sales numbers got better consistently, right? Then in 2022, we had the bear market. People weren't shopping so much. But, while the S&P has made new highs relative to 22, the reality in retail is that it's gone flat for well over a year. You can look at that from a bullish perspective and say, well, it just means the only way it can go is up from here. The market will pull it up with it. Or you can look at it from the bearish perspective and say, well, it's been dragging for so long. As soon as the market rolls over, this goes down. And the reality is, if you draw the channel lines, whichever way it breaks out is telling you which way it's going to actually go. So there's no point in guessing. But whichever way Redbook goes, probably so goes the market and the economy. Wednesday, everything's closed for Christmas. Thursday, initial jobless claims were 219 versus an expected 223,000, so a little bit better than what was expected. Continuous claims, however, were 1,910,000 versus an expected 1,875,000. So fewer people than expected submitted initial jobless claims last week, but more people than expected were on continuing claims. And the S&P was basically flat, down 0.04%. And Friday, we didn't have any significant economic data, but at noon, actually I was just looking at it, and it's just about noon right now. The market's S&P's down 1.6%, which leads me to the 3 big picture reasons, right? Not big reasons, big picture reasons that you could be bullish in 25. Okay. The first one is the Santa Claus Rally. So up until today, we had been doing really well on the Santa Claus Rally. There's not much point in looking at it day for day. We talked about it last week. Santa Claus Rally was coined by Yale Hirsch in the Stock Traders Almanac back in 1972. He defined the time frame as the final 5 trading days of the year and the first 2 trading days of the following year. And so these 7 trading days have historically shown higher stock prices basically 80% of the time, right, in the S&P 500. So it's pretty good odds that you get a positive over that 7 trading day period. And the average has been 1.4%. And then that's the first of the what they call the triumvirate. So the Santa Claus Rally is the end of December, first couple days of January. Then that's the first one. The second one is the first week of January. And the theory is that, as goes the first week of January, so goes the month. So if January is a positive week, if the first week of January is a positive week, the month is likely to be a positive month. And then if January is a positive month, the year is likely to be a positive year. A lot of times that's true. Sometimes it's not. But, 80% is pretty good. This is what it looks like. This is what it looked like as of the close on Thursday night. This was this was where the market closed on the 23rd. So this was the first trading day. 24th, it was a half trading day, but it was the first in that 7-day window. And so we were up quite a bit. I can't remember what the number was. It was up quite a bit on Thursday. It was basically flat the next day. But if you took the distance from where we closed on the 23rd to where we closed Thursday night, we were up 1.07%. So the Santa Claus Rally at that point was up 1.07%, which, we still have several days. We have until this dotted line, right, till the 3rd of January. And the average was 1.14%. However, as of right now, as of noon, the market is down 1.6%, which puts us about here. So as of today at noon, we have wiped out so far the Santa Claus Rally. So we shall see what happens going forward for the next couple of days. All right. Decennial Cycle. This is pretty interesting. Imagine if you took the years ending in 0, 1, 2, 3, right throughout the decade, and you took the average from 1897 to 2020, and you linked them all together. That's basically what this chart is. It's the average of all the years ending in 0 next to the average of all the years ending in 1. Okay, so it goes like that. It's not one continuous trend. It's all those years sat next to each other, basically. Okay? So you can take them all out individually. Most of the years in 0 look like that, right? Most of the years ending in 1 look like that. The important thing for us is most of the years ending in 5 look like this. It's by far the biggest move in the decade, on average. So I thought that was pretty interesting. I go back to ChatGPT, and I ask it, what are in the past 100 years, the years ending in 5, what's the performance? And it's pretty unbelievable. I mean, there are a ton of 30% or more years ending in 5. And the only one in the last 100 years was 2015, was down 0.7%. I mean, that's unbelievable. So if you're talking about odds, now given you only get one data sample every 10 years, but still, to bet against a year ending in 5, wouldn't work very well in Vegas. If you kind of dig more into it, though, you tend to have bad 4 years that lead into strong 5 years. So if you go back to this one, the 4-year tends to be basically flat until the end of the year, and then it starts breaking out. That's obviously not what we had this year, right? We had a 3-year that was really strong, and this year we also had a 4-year that was really strong. They were both up 25%, more or less. So really, we didn't get this consolidation that would give us the impetus for this big 5-year. So we'll have to see what happens. Personally, I think the pattern is more important, so it wouldn't surprise me if we didn't get a monster 5-year like this. But we'll see. And then the third one is a liquidity cycle. So if you guys have never heard of Michael Howell from Cross Border Capital, I would definitely get on YouTube and take a look at his stuff. It's really, really good. He basically focuses on what he calls global liquidity. And the dotted red line is basically just a sine curve, but it corresponds to the black line in terms of peaks and troughs. So it's hard to tell how high it's not designed to go as high as the top of the peak on the sine wave. It's more of a timing tool. Okay, so whatever this peak gets to at the peak of the sine wave is as high as you're going to get. It's pretty consistent, but all the way back to 1970, right? So global liquidity is basically when the Fed is easing, it's putting liquidity into the system. When it's refilling the reverse repo market, it's adding liquidity to the system. When the Fed's printing, it's adding liquidity. When the Fed is decreasing its balance sheet, it's taking liquidity out of the system. But at the end of the day, when global central banks are adding liquidity to the system, the market tends to go higher. And when it's pulling liquidity out of the system, the market tends to go lower. So you can kind of see, as it's pulling liquidity out of the system, we're bottoming here, right? This is 2000. Yeah, where are we here? 2009 is right here, right? 2009 is the bottom, and this is kind of interesting because as liquidity is rising, as it gets to the top, the momentum of liquidity is decreasing, which Howell is kind of all over YouTube right now talking about that with respect to where we are right now. It looks like, liquidity has been going up since, this is the end of 22, beginning of 23. We had a bottom in liquidity, and then global liquidity really picks up, and we had a big 2023 and 2024. But now the rate of liquidity increase is decreasing. So this line is not going to go up as fast. He's talking about it only getting up maybe to there and rolling over. So his bigger concern is 26. Once we do get as high as we're going to get and we start to roll over, that's when the market really starts to tank. And he thinks that happens in closer to 26 than 25. But he thinks 25 is the transition year from strong global liquidity to really weak global liquidity. And the other way you can look at it is like this. These are the peaks the peaks in liquidity are down here. Okay, so it's almost a flipped upside down chart. So when liquidity, he's saying ample liquidity is down here, and there's refinancing tensions up here. So you don't have a lot of liquidity, and you need that to refinance debt. His whole system is based on this idea that global liquidity is required to refinance debt, and the whole world is moving on debt. It's not moving on money that creates things. It's moving on refinancing debt. So this is where we're going to be in 2025. It's moving back up towards this line. So it's not there yet, but it's moving back up towards that line. So there's decreasing liquidity going in, but it's not negative yet. When it gets above that line is when we start to have problems. And as liquidity really decreases, you have things like Eurozone banking crisis, Lehman Brothers, the Y2K. So it's worth checking him out. His work is really, really good. And global liquidity is definitely the thing that drives the ability for companies to refinance. And if liquidity continues to shrink, things get ugly. Okay, TSP Fund charts. So C Fund this is as of Thursday's close. So again, this is going to be different once the market closes today. But if you're following on a weekly basis, you get the 20-week moving average line. And we're still, we've been above that line ever since we got above it back here in October 2023. So, yep, we've had some pullbacks along the way. There's no way to know if this is going to end up being some kind of significant top. But if you aren't looking at it on a weekly basis, you're good to go for the time being. S Fund, obviously a much bigger pullback over the last few weeks than we had in the C Fund. S fund's off more today too than C fund is, so it's definitely trying to hold support there at that 20-week, and hopefully it does. Because more importantly is this prior peak. If we get below that prior peak, it's not great because this should be providing support. I fund, not great, right? You got a lower low, very little bit of a recovery this week, and declining relative strength. So I fund really doesn't look very good. And the F fund also, it almost looks like the same chart. Barely any recovery, really none this week. And we have lower lows from this support level right here. So, I mean, if we can't maintain this, say 1925 level, F fund is not looking good. So I know we said that was going to be and the G fund, of course, always goes up and to the right. So I know we said it was going to be kind of a bullish, 3 bullish reasons into 2025, and it kind of is. Michael Howell, the liquidity picture is getting worse, but it's not risk off yet. Okay, so that's still positive for 25. What was the other one? Claus Rally, Liquidity Cycle. Decennial. Yeah, I mean that's just statistically, like, betting against year ending in 5 is, it's not a great bet, right? But if you look a little bit further into it, the pattern leading into it in 2024 is not the consolidation pattern that we usually get to get a big move up in the 5th year. So just something to keep in mind. And then the Santa Claus Rally, if we can keep on going, the market doesn't have to get to new highs, but it would be good if we had a positive Santa Claus Rally, and a positive January would be ideal.
Yeah, a lot of things to be keeping your eyes out for. I mean, this is a time when most of us aren't looking at the market. We're if you are, it's because you're bored at home.
We had like 100 people on the
our call last night.
Call last night. Yeah, it was great.
It was. So people must be bored at home.
Yeah.
But anyway, hope you're getting to spend some time with family and friends during these holidays. And we got one more coming up with New Year's, and we'll keep an eye on the market for you. Just watch the show.
There you go.
All right. If you like it, share with your friends. If you don't, share it anyway.
Have a good week.
Yeah, we'll see you guys soon.